I'm sure you've heard it over and over again how important tax planning is for pre-retirees and newly retired individuals. And that is not wrong at all. Tax planning is extremely important when integrated appropriately within the overall retirement plan. And one of the most common ways for many people to initiate their tax planning, especially in retirement, is by utilizing Roth conversions, transferring the tax liability in accounts like 401ks and IRAs to Roth 401ks or Roth IRAs, taking on that tax liability today so you're not forced to take it on at any certain point in the future. However, just because you can convert money into a Roth doesn't necessarily mean you always should or have to. There are instances where converting money is ultimately not what you should be doing when it comes to your tax planning. So in this video, I'm going to explain 3 reasons why Roth converting money from an IRA or a 401k to a Roth account is something you shouldn't do when it comes to your long-term tax planning. Hi, my name is Derek Delaney. I'm a certified financial planner, and these are the type of conversations I have with my clients for a living. So let's talk about 3 reasons why converting money to a Roth IRA or Roth 401k is not appropriate for a soon-to-be retiree or a newly retired person. And we're going to find 3 reasons why that aren't talked about often but could come into play at some point down the road and completely blow up your thought of converting money or the tax benefits of converting money from an IRA to a Roth IRA. So reason number 1 is you potentially moving to a new state that doesn't have a state income tax associated with it, where the current state you're living now does. So think about this. Let's assume that you live in Minnesota, and Minnesota has a state income tax, and as you are saving money into an IRA or a 401k, you are deferring that money from being taxed at that state income tax percentage. And now let's assume that when you're retired, you're going to move to a state that doesn't have any sort of state income tax, like Texas. Why would you convert now and incur that state income tax liability while you live in Minnesota if you could hold off for a couple of years until you transition and make that move to Texas and then start your conversions while you're located down there? Then you don't have to incur that state income tax liability. Reason number 1 why converting money to a Roth is something you shouldn't do is because you plan to, at some point in the future, move to a state that doesn't have a state income tax, where the state you are currently associated with today does. Reason number 2 is you would create a tax liability snowball by initiating a Roth conversion that would otherwise make the benefits of that Roth conversion not valuable at all. This happens more often than not, where you incurring some sort of tax liability because of a Roth conversion initiates additional taxes you weren't aware of or planning for that year. For example, if you convert money from an IRA to a Roth IRA and you've started Social Security and you don't have a lot of other income sources on your tax return, that conversion could initiate increased taxation on that Social Security that you otherwise would not have incurred. Or you have a lot of long-term capital gains on your tax return this year and you initiate a Roth conversion because you think you're supposed to. That Roth conversion could push up a lot of those long-term capital gains in the 0% long-term capital gain bracket up into the 15. Now you're saving 5-10% on future tax liabilities by making that Roth conversion, but now you're pushing up 0% long-term capital gain taxes into the 15% bracket, so that trade-off isn't as beneficial, or it could actually be punitive. And then there are other things you're going to want to keep an eye on in retirement. A Roth conversion increasing your Medicare premium costs because of IRMAA surcharges. Another really important factor to look at and reason why Roth conversions could ultimately do more harm than good is because of the snowball effect of tax it could have on other areas of your financial life that you're not considering due to that Roth conversion. And then reason number 3 why doing a Roth conversion today might not be beneficial is because it's going to not provide you with IRA or 401k money that you could spend naturally at any point in the future much more tax efficiently. Let's assume you're in the 22% tax bracket and you want to convert all your IRA money to a Roth IRA. And that conversion will keep you in the 22 or 24% bracket. And you initiate that. And now all your money's sitting there in Roth accounts. And you feel really good about yourself. However, if you find yourself continuing to spend money at that point moving forward later in retirement, and tax rates are actually smaller toward the bottom and you don't anticipate filling up those bottom brackets completely based off of your spending or other income sources, those would have been prime years to naturally spend your IRA money, because now you're naturally spending it at the 10 and 12% bracket, whereas before you converted it into 22 and 24. Other reasons that you naturally might be able to spend more tax efficiently outside of filling up lower tax brackets is, what if you get later on in life and you have to spend a tremendous amount of money from your IRA to pay for healthcare expenses? Well, you could turn around that year and itemize those expenses on your tax return. Bigger itemized deduction compared to the standard deduction that you would have had to make could be enough to eliminate the tax liability due because of those big or significant IRA withdrawals you had to take in order to pay for those healthcare expenses. The ability to itemize for healthcare expenses can neutralize the tax liability of taking that IRA withdrawal later in life, is another reason why you could spend IRA money more efficiently down the road than converting it earlier. And then finally, a really common one that a lot of people miss is you can still pay your financial advisor, financial planner, advisory firm from those IRAs tax-free. Not converting that money and paying the financial advisor, especially if you're paying the advisor a significant chunk of change every single year, could be beneficial because you're able to pull that money out of your IRA tax-free to pay that advisor, which could be one of your biggest expenses later on in retirement, instead of converting that money and paying the tax liability at the 22 or 24% bracket like we used in our original example. Know that Roth conversions are extremely beneficial if your specific plan dictates that it is beneficial, considering what we think your spending is going to be in retirement and where we think that spending is going to put you from a tax liability standpoint 5, 10, 15, 20 years down the road. But know that because you can convert money from an IRA to a Roth doesn't mean you need to, and there are some instances where it would be more beneficial not to make those conversions and to otherwise spend that money naturally later on out of those IRAs for all the reasons we just got done talking about. Now, retirement planning can get confusing. Adding on the layer of proactive tax planning can make it extremely complex. If you're looking for a flat fee wealth management firm and somebody who can serve as your personal CFO as you navigate to and through retirement, that is exactly where I sit when it comes to the work I do with my clients. If you're interested in learning more, I invite you to schedule your free consultation, and I'd be happy to chat about your specific situation and how it fits into the service model and work I do for my retiree clients. Until that future conversation, happy retirement planning.